You're listening to Let's Talk Macro.
Brought to you by Bandhan Mutual Fund.
Hello, everybody. Welcome to Let's Talk Macro, the podcast on macroeconomics by Bandhan Mutual Fund, where we discuss interesting global and domestic macroeconomic topics and events. I'm Ahalya, your host for the day, and as per usual, we have with us Sreejith Balasubramanian, economist in the fixed income fund management team, here to give us all the details about everything we need to know on the macroeconomic front right now. Hi, Sreejith. Welcome back. How have you been?
I'm good. How are you earlier?
Doing very well, and we have quite an interesting topic of conversation at hand today, Sreejith.
Yeah.
And I have to say, I think this year has just been keeping you on your toes, no?
Yeah, no, absolutely. A bit of crazy time, actually.
Yeah, we've had plenty of action on the domestic front with likely GST rate cuts soon, a good monsoon and crop sowing season so far. But then on the other hand, we've got the proposed higher US import tariffs on India and a cyclical domestic economic moderation. So in today's episode, we're focusing on the home front. We're going to discuss these very pertinent aspects, their impact on the Indian economy, and also give all of you, our listeners, a broad view of the economy today and what lies ahead. So Sreejith, first, let's ascertain how the economy is currently doing. How do you see it in terms of data?
The straightforward answer to this question is that cyclically we are in a bit of a moderation. So year-on-year growth in corporate and income tax collected, say till end of June this financial year, is negative. And credit growth, so consumer leverage, has been softening. And industrial production and vehicle sales growth have been modest. But we've seen tax collection in recent years, for example in FY24, early part of FY24, rebound after a slow start. So we'll have to wait a bit for that. CPI inflation has been very soft, and the outlook for the next few months is benign. We know monsoon rainfall progress has been quite good this year, and kharif crop sowing, particularly in food grains, has also been good. Reservoir levels are up again. So overall we have moderation, but pockets of data holding up quite well. Of course, there are uncertainties on the trade front, and the global growth outlook in general is softer this year.
Okay, perfect segue, because that is my next question. Given the uncertainty on the trade front, right, how do you see the impact of the higher tariff announcements that were recently made by the US playing out, and how exposed are we to this possibility? Is this very real that we actually have to contend with? Can we just live in denial for a bit longer?
Yeah, so the US has imposed 25% reciprocal tariff on India, and an additional penalty of 25% for our import of Russian crude oil. And this is supposed to take effect from 27th of August. So we'll have to see how that plays out. But first thing is that the around 20 to 30% of our exports to the US, like electronics, pharma, and so on, are exempt from those tariffs. So the rate that we're talking about is applicable on the remaining, let's say, 70 to 80% of goods. But the effective rate, therefore, is still quite steep if you compare it to the higher tariff rate that has been imposed on other countries. Our rate sort of stands somewhere on the top as it is now. The 25% tariff with the exemptions, therefore, could have an impact of around 30 basis points on GDP growth this year, that is FY26. The impact on current account deficit should be marginal, given there has been already some front loading of exports to the US and therefore related imports as well. But again, and let me reiterate, a lot of this will depend on the final numbers, exemptions. We've seen pauses before any sort of a response from India, etc. But these are the broad contours in terms of numbers. And again, let's remember the share of exports, that is of goods and services in India's GDP is around 21%, which is lower compared to some of the other emerging market economies. Particularly our Southeast Asian export-focused economies. And India's trade surplus with the US is around 1% of our GDP. Also, our crude oil import from Russia, that is a volume, and the discount on it, let's say the discount per barrel, that is, are also well below its peak now, which was much higher after the onset of the Russia-Ukraine war. That's much lower now. So we overall have space to maneuver.
Okay, so that's interesting because this uncertainty is basically, accompanied by some space there as well. But given the cyclical moderation in the trade uncertainty, Sreejith, what counterbalances do we have within the economy? And also, what measures are we seeing in terms of policy action? Is this already being implemented?
So that's an important question. So one thing is that, like we just mentioned, areas like rural potentially doing better. As inflation is eased, which improves the real wages, Kharif harvest hopefully doing better, etc. And those things can help. The pockets where data has been holding up well. One such area is rural this year. Globally, if you see, we've been talking about how we think US Treasury yields should eventually ease in line, with the weaker data there and higher expectation of Fed rate cuts. Therefore, we're starting to see that a little more clearly now. Consumption and investment growth in the US has slowed in the first half of this year, and labor market data, if you see, in terms of non-farm payroll additions, which eased sharply in July, and even the previous month's numbers got revised down considerably. So this sort of points to weaker data being seen a little more clearly. In fact, at the recent Jackson Hole summit, the Fed chair said downside risks to employment are rising, and if those risks materialize, then it can happen quickly through much higher layoffs and rising unemployment. So the possibility of a wage price spiral from tariff impact on inflation is unlikely, and the tariff impact could therefore be short-lived. Given this, he also said the Fed's policy stance may need to be adjusted. So generally the expectation of rate cuts have picked up a bit more, and this is good for emerging markets like India. We've discussed this before, because US dollar weakness could continue. And that allows more freedom in our domestic policy making.
Yeah, again, a very valid point there. There's this potential domestic and global counterbalance that we have in place. But what about the specific policies? The GST rate cuts are likely happening soon. So anything on that front that is important to keep in mind?
Yeah, so if you actually take one step back and see, our private consumption growth has been moderate right from pre-pandemic. And private investment growth, therefore, has not picked up materially. It is public investment, that is government investment, that had largely stepped in. So some reallocation of resources, if you see sort of within the pie towards households, is understandable. In the budget, that is the FY26 budget, we saw income tax cuts, right? And now GST rates rationalization is likely happening soon, with media suggesting the 12% slab could get merged with the 5% rate slab. And many items in the 28% slab could get merged to the 18% slab. The current 12% slab comprises of packaged foods and beverages, apparel, pharma, etc., which is around 5 to 6% of the total GST revenue. The 28% basket includes home appliances, cement, auto, and so on, and that's around 13 to 14% of GST revenue. So the proposed rate change that we keep hearing now implies a fiscal impact of around 50 basis points of GDP, and the growth impact could somewhere be similar as well. But the point to note here is that only 1/3 of the revenue hit is borne by the center, while 2/3 is by the states. Again, the impact this year, if you see, is will only be half of this, because we already the implementation is likely from September or October. And again, the other important thing to remember is that there are potential offsets to the revenue impact. And if you look at the avenues for that, it's possibly from lower input tax credits claimed by businesses, because as the rates go down, the tax credit claims also could go down a little based on the rates. Utilization of compensation cesspool, and what lies ahead for the cesspool is something that we'll have to wait and watch. The possibility of excise duty hikes on petrol and diesel, that is without impacting the retail price, like what we saw in April this year. That's potentially one offset, and we've already seen a strong RBI dividend number this year. So the fiscal impact this year is therefore very marginal. And even for next year, the impact is likely not material. And again, another important point here is that some early news flow suggests the 8th pay commission implementation could be a bit delayed. So, that will be effectively an offset. But all said, I think the really important point here is that we see the central government's hard-earned fiscal credibility reflected in the, the recent sovereign rating upgrade by S&P after 18 years. We see that credibility continuing. And I think that's the really important point here. And again, if you look at the impact of GST, rationalization, there'll also be some downward impact on inflation, but that'll depend on the eventual pass-through by companies to consumers. And in this context, in this economic backdrop, let's also not forget we have a very proactive RBI, which is cut policy rates and injected liquidity, and transmission there is also in progress.
Nice. Okay, that was a really fantastic breakdown. Thank you so much, Sreejith. And I think with the last point, in comparison to different economies that we've talked about, that injected liquidity, the rate cut policies, etc., all very important movements, right, for us to be taking into account. So decent growth impact from the GST rate cuts with a modest revenue impact shared by the center and states. But most importantly, I think fiscal credibility should continue. With that, it's time for me to summarize the key takeaways from today's episode, so everyone listen in carefully. First, cyclically, there has been some moderation in growth as seen in data on tax collection, credit growth, and industrial production. However, these are areas like rural, which could recover well in line with the good monsoon rainfall, crop sowing, and reservoir levels this year. Second, higher US tariff rates pose uncertainty directly and indirectly for India. The 25% reciprocal tariff with the exemptions in place could have an impact of 30 basis points on GDP growth this year and a marginal impact on the current account deficit. However, the dynamics of India's trade with the US and our crude oil import from Russia offers some space for maneuver.
Yep.
The more visible weakness now in US data and higher expectations of rate cuts by the Fed also implies that US dollar weakness could continue, which should benefit us. And finally, the RBI has been proactive with rate cuts and providing liquidity. The cost of fiscal support this year in terms of GST rate rationalisation, likely to happen soon, is marginal, to be shared by the states as well, and there are also offsets to the revenue impact. We'll also have to see the timeline of the 8th Pay Commission implementation, given the possibility of a delay. Overall, don't really see any reason for an abrupt change to material fiscal expansion by the centre. So the hard-earned fiscal credibility, as acknowledged by S&P also during the recent sovereign rating upgrade, should continue. With that, we arrive at the end of today's episode and this month's macroeconomic rundown. Thank you so much, Sreejith, for joining us. I'm pretty sure this discussion was very useful for everyone listening in today.
Thank you, Alia. As always, my pleasure.
All right, we'll be back with another episode of Let's Talk Macro. Until then, bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.